Sounds almost too good to be true, right? But in today's investing world, there are ETFs that aim for high monthly payouts using option strategies. Chasing yield without understanding the mechanics and risks is a dangerous game. Here's a guided tour through aggressive, high-yield, monthly paying ETFs. An ETF, or exchange-traded fund, is a wrapper for a basket of assets that trades on exchanges like a stock. Let's clarify what this means. Some ETFs target capital appreciation, some for dividend growth, and others explicitly target income through strategies like covered calls. The advertised yields, sometimes in the double digits, are based on distributions, strategy income, and sometimes return of capital. They are not guaranteed. With that in mind, here are 5 ETFs widely discussed by income investors that aim for high monthly yields. One of the newer entrants is OMA, a Buffett-inspired high-income ETF that holds Berkshire Hathaway shares. Its main income generation is covered call writing on those holdings, targeting a 15% annual distribution rate. The logic behind this is that Berkshire doesn't pay a regular dividend, so Omaha uses option premiums to generate cash flow. However, keep in mind that covered call income limits upside potential in strong bull markets. Another aggressive income play is ITWO, using a daily covered call strategy over the Russell 2000 index. Designed to generate high monthly income via option premiums while providing equity exposure to small-cap stocks. In 2025, reports suggest ITWO yields around 14+% annually. You participate in small-cap upside until the call options are exercised. In sharp rallies, ITWO might lag. The NEO suite includes ETFs like QQQI and SPYI, overlaying covered calls on major indexes for consistent income. SPYI currently targets monthly income with an annual yield in the 12% range. These ETFs may have more cushion in bear markets, but they still carry volatility. Some of the best-known income ETFs in this space are QYLD, XYLD, and JEPI. They generate yield by writing call options on underlying indices or portfolios. QYLD and XYLD tend to yield high, sometimes in the double digits. JEPI blends equity selection with option overlay, aiming for smoother returns. They tend to underperform in strong bull runs, but in flat or downward markets, the option income can be a powerful buffer. Lastly, you'll see the Global X Super Dividend ETF, SDIV, and Global X Super Dividend US ETF, DIV, mentioned in monthly dividend lists. These funds focus on high dividend-paying stocks globally or domestically. Their monthly pay structure appeals to income investors. They tend to have higher volatility and sensitivity to global market swings. Because they lean heavily into yield-focused names, capital swings can be large. Many of these ETFs rely on selling call options. In strong bull markets, that means you miss out on upside. The options provide income but cap growth potential. The high yields are often based on recent performance. If markets shift, option premiums compress, or volatility declines, yields may fall. Some distributions may include return of capital, ROC, not pure income. That can complicate taxes and principal erosion. High-yield monthly ETFs often live in volatile assets. A 20% drop in the underlying can overwhelm income gains. Dividends may be qualified or non-qualified, depending on holding period and ETF structure. Income from option trading is often taxed as ordinary income. High-yield, active, or derivatives-based ETFs tend to carry higher fees, which eat into net return. Some niche ETFs are lightly traded, which can mean wider spreads and more cost to enter/exit. Allocate a small portion, 10 to 30% of your total investments, to high-yield monthly ETFs, while keeping the rest in core dividend or growth holdings. Monitor distributions, yield trends, and option volatility. Rebalance when yield gets too thin to maintain portfolio stability. Track metrics like SEC yield, distribution consistency, and option premium trends for assessing ETF performance. If yield drops 20 to 30% below target levels for several months, it may signal pressure, so be attentive to those signs. For example, with $100,000 deployed in an ETF yielding 14%, you earn about $972 a month before taxes and fees. Keep in mind how OMA-H targets a 15% annual yield with monthly distributions, an ambitious goal reflecting innovative strategies. When people first hear about ETFs promising 15% or even 20% annualized yields, the reactions are disbelief, excitement, and then doubt. Income like that doesn't appear out of thin air. It's created through specific financial engineering methods, primarily option overlays and leverage. You need to unpack how the distribution is generated, its sustainability in market environments, and align it with your financial goals. Take QYLD, the Global X NASDAQ 100 Covered Call ETF. It appears ideal, holding NASDAQ 100 stocks and selling covered calls. The yields often hover in double digits, attracting investors as a pseudo-income replacement tool. However, examining its total return over long horizons reveals critical underlying realities. The income is real, but it comes at the cost of growth. By continuously writing call options, QYLD is systematically capping its upside potential. When the NASDAQ runs in a bull market, QYLD lags dramatically behind because the calls sold prevent capturing those gains. In flat or choppy markets, QYLD shines by harvesting volatility premiums without missing much growth. Investors holding QYLD, expecting high yield and big capital appreciation, are likely to be disappointed. The fund's purpose isn't wealth compounding, it's income harvesting. JEPI, the JP Morgan Equity Premium Income ETF, has exploded in popularity as it tries to balance the equation. It pairs option income strategies with active stock selection. JEP offers sustainable yields in the 8 to 12% range and retains more upside during bull markets by not overwriting 100% of its exposure. Investors seek the best of both worlds, high income and growth, which JEPI aims to provide. Finance rarely gives you both high cash flow and growth. The art is knowing which trade-off you're comfortable with. Do you want sky-high cash flow? QYLD-style products fit. Want balanced income with growth potential? Consider JEPI or SBYI. Next, there are funds like OMA targeting a 15% annual yield with monthly payments. This is where it gets complicated. Omaha's model relies on Berkshire Hathaway, which doesn't pay dividends. It promises yield by using aggressive option strategies. When markets calm, income from options declines. Funds may need to dip into capital to maintain yields, masking risks. This risk is similar with SDIV, the Global X Super Dividend ETF. Investors must tread carefully. Its yields often look massive, but the total return history shows prolonged underperformance as underlying holdings are risky high dividend names. One critical mistake many income-focused investors make is confusing yield with return. Yield is just the cash you're paid out, expressed as a percentage of the current price. Return is yield plus price appreciation. If you get a 15% yield, but lose 15% in capital value, your return is zero. Understanding distribution composition is crucial. Some high-yield ETFs disclose a significant portion of payments as return of capital. Taxation is another layer. For U.S. investors, qualified dividends receive favorable tax treatment, but option premiums do not. International investors face complexities as withholding taxes reduce effective payout. You need to calculate your after-tax yield, not just the headline number. In fixed income, a 6 to 7% yield is high for corporate bonds. Junk bonds may push into 8 to 10%. Real estate investment trusts often yield 4 to 7%, sometimes 8 to 9% for riskier plays. 15% yields from an ETF are unconventional, not backed by cash flows. It's synthetic income from selling volatility. Compounding accelerates if you reinvest monthly distributions, but matters only if the total return is positive. Investors on QYLD or SDIV often report stagnation or declines, underestimating capital erosion. The yield trap lures investors with promises of cash flow, but often leads to mediocre returns or losses. These ETFs aren't bad. They're tools that work if used properly. For retirees prioritizing income, they can make sense. Consider them yield supplements for diversification, not miracle investments. Pouring life savings into one ETF is unrealistic. Imagine volatility dropping like in calm 2017 markets. Income drops. Or markets crash like in 2008, yet income potential rises with falling equities. In both scenarios, investors face disappointment, either lower income or capital loss. The sweet spot is sideways markets with volatility. But history shows markets don't stay in that sweet spot forever. High-yield ETFs will always have cyclical performance. In Canada, covered call ETFs are popular as investors crave income. BMO and Horizons are examples using similar strategies. In Europe, UCITS products mirror this approach. The hunger for yield is global, and the financial industry innovates. High yield is not free. It comes with structural trade-offs. Investors need to be aware of this. Consider blending your investments. Build a basket of ETFs like JEPI, QYLD, and SCHD to diversify yields. Focus on weighted average yield instead of chasing the highest number. A sustainable 9% can be better than an unsustainable 15%. Entering ETFs when volatility is low can mean lean distributions, but buying after a spike may lock in fatter premiums. Active investors use metrics like the VIX to guide their allocations, adjusting exposure based on volatility levels. Many retail investors are drawn to high-yield ETFs because frequent cash flows satisfy emotional needs, despite lower long-term gains. Advisors often caution against yield chasing, but the industry continues to offer products tailored to this demand. In modern portfolio theory, balancing risk and return is key, yet high-yield ETFs have found their niche in today's environment. They promise bond-like regularity with equity-linked payouts, but the correlation structures matter. If your entire portfolio is equity-based and you layer in high-yield covered call ETFs, you haven't actually diversified away from equities. your capital still rides with the equity market. That's why institutional investors hesitate to use these as substitutes for true fixed income. For retail investors, however, the perception of diversification is often enough. You'll hear people say, "I own JEPI, QYLD, SDIV, and OMA, so I'm diversified." In reality, most of those funds are variations of the same equity income play. Real diversification would involve mixing asset classes that behave differently under stress. Some advisors suggest capping exposure to high-yield monthly ETFs at 10 to 20% of a portfolio, instead of making them the core. Liquidity is crucial for ETFs. While many trade with healthy volume, some, like SDIV, don't. Lower liquidity means wider spreads and potential losses for active traders. In moments of panic, prices can sharply deviate from net asset value. This can spook investors seeing ETFs at steep discounts. For long-term holders, liquidity may be less critical. However, active traders must consider it for managing entries and exits. The ETF industry is evolving, with new high-yield strategies emerging. Funds are experimenting with double-leveraged covered calls. Leveraging dividend stocks can enhance income, but also increases risk. History shows these innovations may not always succeed. Every strategy has a stress point. Investors should remember what happened with mortgage-backed securities in 2008. Products that unraveled during crises due to misunderstood risks. Covered call ETFs, while not systemic like 2008 securities, also illustrate that complexity can hide fragility. Investors crave substantial income. ETFs that pay monthly and offer double-digit yields tap into that demand. Like comfort food, while these investments are easy to understand and rewarding emotionally, they may not always be healthy long-term. The key is moderation. A little can be satisfying, but too much can be harmful. You know that moment when payday hits and your bank balance finally looks a little healthy? What if I told you that money could keep growing without you lifting a finger or answering to a boss? Because with just 50 grand in 2 simple ETFs, your cash could outwork your full-time salary. It's about putting your money somewhere sensible and letting time and compounding do the heavy lifting. That's where ETFs come in, exchange-traded funds. They may not sound sexy, but they are powerful tools. An ETF is basically a basket of different companies wrapped into a single investment. If one company inside the basket stumbles, the others help balance it out. The real trick is simplicity. Pick funds that make sense, give exposure to growth industries, and then leave them alone. No late nights with charts or guesses about CEOs. Just steady, boring consistency that creates powerful outcomes over years. We're stripping away the noise and focusing on just 2 ETFs. One is fiery and packed with growth. The other is calm and steady. The first one is SMH, the Van Eck Semiconductor ETF. This fund is tied to semiconductors, the tiny chips powering everything. With the world advancing in AI and automation, the demand for semiconductors is not just growing, it's exploding. Every time someone fires up an AI model, chips are working overtime in the background. The entire digital universe is built on them. SMH gives you exposure to the biggest players like NVIDIA and Taiwan Semiconductor, companies leading the charge. But semiconductors are a roller coaster. When demand is high, SMH shoots up like a rocket. But downturns can hit hard. Take 2022 as an example. Supply chain nightmares and rate hikes tanked SMH. Investors felt the gut punch of their portfolios. But semiconductors aren't a fad. They are the backbone of modern life. The sector rebounded and SMH came storming back. Over the past 5 years, SMH has delivered around a 288% return. Put in $1,000 and you'd have nearly $3,800. If you had invested $25,000 into SMH 5 years ago, you'd be looking at close to $97,000 today. SMH is the wild child of ETFs. Volatile, unpredictable, but capable of turning a modest sum into something jaw-dropping with patience. It's like that talented friend who sometimes vanishes only to show up later and blow everyone's expectations out of the water. You love the potential, but the ride can be tough. It's dangerous to put all your eggs in this one basket. The growth potential is huge, but the volatility can crush you without balance. The calmer, steadier fund, VOO, acts like the anchor to SMH's rocket. When paired together, they create a powerful investment strategy. VOO is the reliable older sibling. It moves upward predictably and steadily, providing a heartbeat for your portfolio amid SMH's swings. VOO is built to mirror the S&P 500, a collection of 500 of the largest companies in the United States. When you own VOO, you own a slice of Apple, Microsoft, Amazon, Johnson & Johnson, Coca-Cola, Exxon, and more. You're betting on the entire American economy to keep growing, which historically has been a safe bet. VOO has been the single best wealth-building vehicle for ordinary people for decades, with a steady 10 to 11% return. Boredom in investing is good. With VOO, you can live your life without obsessing over your portfolio. Think about splitting $50,000 into $25,000 for SMH and $25,000 for VOO. Your SMH side has grown from $25,000 to $32,500. Your VOO side has increased from $25,000 to $27,500. Together, that's $60,000. Just leaving your money alone reaps $10,000. Fast forward to year 5. The SMH side has ballooned to nearly $93,000, and VOO is around $40,000. Together, that's about $133,000. You didn't trade or hustle. You just let your money sit, doubling it in 5 years by doing nothing. By year 10, the SMH side has exceeded $400,000, with VOO in the mid-60s. Combined, that's about $500,000. From just $50,000, that's the power of compounding when you let it work over time. With a regular job, you earn $50,000 a year. But after taxes and bills, there's not much left. With investing, the story changes. Yes, there are risks, but the growth curve may outpace a paycheck. You're not just trading hours for dollars anymore. Your money works even while you sleep. With investments, money multiplies over time. The first couple of years may feel slow, but growth accelerates. Risk is real. Returns vary year to year, and external factors can stall growth. But a longer time horizon helps. The S&P 500 has seen many crises and still climbs. Technology continues to move forward, ensuring growth. The beauty of pairing SMH with VOO is balance. When SMH stumbles, VOO steadies you. Together, they cover both sides, the explosive and the dependable. One scratches the itch for big returns. The other soothes your nerves when things get rocky. It's like having a sprinter and a marathon runner on the same team. By the end of 10 years, your invested $50,000 has matched what a full-time job would pay in gross income over the same span. Your money doesn't need sleep, holidays, or call-in sick. It just keeps grinding, quietly and relentlessly. There are risks in investing, and pretending they don't exist would be a lie. While you can't control market moves, you can control your habits. The biggest trap people fall into is checking too often. Open your portfolio daily and you'll see nothing but noise. One week you're up 1,000, the next you're down 2. It feels like chaos. Don't let emotions dictate your actions. The secret weapon for long-term investors isn't intelligence, it's emotional discipline. Can you stay calm during the storms? Another risk is assuming history will repeat itself perfectly. The future returns could be different. That's okay. Adding small, consistent contributions changes everything. Think about how compounding works with regular investments. That's how ordinary people turn modest salaries into real wealth. Feed your portfolio steadily and let time work for you. At some point, the conversation shifts from "how do I grow this money?" to "how do I live off this money?" That's where something called the 4% rule comes in. If you withdraw 4% of your portfolio each year, the odds are high your money will last for decades. If you've built your portfolio up to $500,000, 4% is $20,000 a year. Push that portfolio to $1 million, and now you're looking at $40,000 a year. Add that to any other income streams, and financial freedom feels more achievable. Instead of worrying about vacation requests, you're deciding if you feel like going to the beach. Money starts working for you. Freedom isn't just about being rich. It's about buying back your time and choosing work you love, not just surviving. This is the quiet revolution happening right under our noses. People are realizing wealth doesn't come from grinding 60-hour weeks forever. It comes from putting money into assets that compound. Think in decades, not days. Balance patience with persistence. There will be moments of doubt. When the market crashes, it'll feel like the end of the world. But zoom out. Look at a 30-year chart of the S&P 500. Every crash looks terrifying, but from a distance, it's just a small blip on an upward curve. The people who panic and sell lock in losses. The ones who stay put, especially those who keep buying, come out far ahead. That same 50 grand you thought of as a number could produce more than your salary, not from working harder, but from working smarter. You don't need to be a financial genius to pull it off. Just start, stay the course, and give compounding enough time to do its work. Imagine yourself 10 years from now. You check your portfolio and see $500,000. You remember the day you put in 50 grand. And you smile because while you lived your life, your money was quietly building a future you once thought was impossible. Imagine waking up each month and seeing $12,000 deposited into your account from a smart investment portfolio. It's important to recognize how much has changed in the investment world. Last month, one investor faced a harsh truth. They missed $175,000 in growth. Following the old advice that worked in the 90s isn't enough anymore. The market is globalized and yields are lower. Why keep money in strategies designed for dial-up internet when today's economy streams in 4K? Sticking to the old path could mean waving goodbye to hundreds of thousands in future earnings. Picture putting aside $500 each month for 20 years. Under conventional plans, that grows to about $250,000. Not bad. Now think about that same investment turbocharged by updated ETF categories, backed by years of research. Suddenly, that stack could soar to nearly $500,000. Double the magic, double the possibilities. The difference comes down to compound interest working for you instead of against you, fueled by returns in endless cycles. But what does it actually take to hit $12,000 every single month? Enough to walk away from a job and live comfortably? Let's break it down together. Every sturdy house sits on a strong foundation. The S&P 500 index is that unshakable bedrock for an investor's future. This isn't a get-rich-quick product. It's the sleep well at night core. Over any 20-year period in recorded history, an investor holding this index has never lost money. The S&P 500 brings a dependable consistency, delivering positive returns 74% of the time in a single year, rising to 83% for 5 years, and an incredible 92% for 10-year stretches. Long-term investors, even during the worst storms, have always come out ahead. There's calm in knowing that these ETFs, VOO and VTI, are quietly adapting with the market. VOO focuses on America's 500 largest companies. VTI adds mid-size and smaller business exposure for extra growth. Either choice means extremely low fees, just $3 a year for every $10,000 invested. The only decision is whether stable giants or broader market diversity feel right. Holding these foundation ETFs automatically upgrades the portfolio as new innovators rise and laggards fade, without the need to make a single trade. When thinking about long-term safety and worry-free sleep, nothing comes close. The performance history tells a story of resilience and opportunity. Every year brings a fresh crop of innovators into the index, ensuring exposure to technological change. Big names like NVIDIA, Microsoft, and Apple aren't just filling headlines. They're forming the core of these funds. Even during rocky years, diversified holdings cushion the impact, spreading risk across sectors. VOO and VTI have averaged annualized returns above 13%, outpacing inflation and rival strategies. These ETFs also bring healthy dividend yields, enhancing growth through compounding. Fees stay rock bottom, making this approach cost-effective without sacrificing quality. Portfolios built on VOO or VTI lean on consistent performance and transparent methodologies. When considering how to weather the next 20 years, few tools offer reliable peace of mind like these market leaders. Tradition calls for bonds to create safety. But let's get candid. Bonds are now a leaky bucket, offering only 1.6% returns. That familiar safe investment has shifted into something quietly eroding wealth instead of growing it. Popular bond ETFs deliver underwhelming results. $50,000 invested becomes just $58,000 after 10 years. It's time to rethink our strategies. Enter the modern hero, dividend-focused ETFs. The Schwab US Dividend Equity ETF, or SCHD, flips the script. CHD carries high-performing, cash-flow-strong companies like Coca-Cola, Chevron, and Home Depot, thriving through challenges. CHD has delivered an average of 11.5% annual returns for the past decade, with a dividend yield close to 3.5%. A $50,000 investment in SCHD grows to about $150,000 over 10 years, providing nearly $92,000 in extra gains compared to bonds. Those dividends tend to grow over time, keeping pace with inflation and maintaining purchasing power year after year. Giant companies in SCHD have survived every economic cycle, delivering both growth and safety. Specialty income ETFs like JEPI and JETQ offer yields as high as 9 to 11%, making $12,000 per month an achievable goal. Is international diversification a must-have, or is it draining wealth? The answer has changed. Globalization means American companies now lead on every continent. Apple and Microsoft earn billions from Europe and China. Reality check. International-focused ETFs have returned just 4.6% a year over the last decade, while growth-oriented tech ETFs like QQQ and QQQM rocket ahead, delivering up to 18.36% per year. U.S. tech and innovation companies form the engine of global growth and dominate the new interconnected world. Investing in growth ETFs centered around these companies means capturing the upside of digital transformation, artificial intelligence, and cloud computing. QQQ and QQQM feature stars like Google, Tesla, NVIDIA, and Meta, giving every investor a front-row seat to explosive progress. Swapping old-school international stocks for growth ETFs is like trading a faded map for cutting-edge GPS navigation. Wealth creation becomes faster, steadier, and more resilient to regional downturns. Growth ETFs upgrade international exposure by investing in global powerhouses underpinned by American standards. American companies are influencing energy, tech, and consumer trends globally, turning local innovation into worldwide impact. With a single purchase of a growth ETF like QQQ, investors can ride the wave of global progress without multiple funds. Transparency in holdings allows investors to see exactly where their money is working, boosting long-term confidence. Growth ETFs have consistently shown the ability to bounce back from downturns, often outperforming broader benchmarks. Investors who track quarterly updates and industry shifts refine their growth ETF allocations for lasting results. Leaning into innovation means investing in strategies that build toward tomorrow, not just preserve yesterday's gains. Earning $12,000 per month through ETFs requires math, discipline, and strategic allocation. It's not magic. High-yield dividend ETFs like SCHD, JEPI, and others yield between 3.5% and 11%. Selection affects your capital needs. With 4% yields, to earn $144,000 annually, you need to invest $3.6 million. Explore aggressive options for reduced capital needs. More aggressive ETFs offering 8 to 11% yields lower the entry point to around $1.5 million. But consider additional risks involved. Some ETFs, like MSTY, promise rates topping 143%. $100,000 invested could generate $12,000 a month, though risks exist. Smart investors check sustainability and reliability and avoid dividend traps, where value may erode despite high payouts. Moderation, research, and review of holdings keep your monthly income steady and resilient. Reliable high-yield ETFs, S&P 500 index funds, and tech giants ensure both security and growth. Regularly review fund performance and spot trends before they impact payouts. Market conditions change. Adjust your strategy for the next year to maintain steady income. Factor in inflation. Yields must keep pace with spending power over time. Transparency in ETF holdings shields against surprises in your income stream. Strategic tax planning ensures more cash stays in your pocket from high-yield distributions. Use automated tools like calculators and simulators to visualize income strategies. Diversify within categories. Avoid overconcentration and shift holdings if needed. Stay updated with ETF newsletters for news on index changes and new opportunities. Adapt strategies based on life stages, transforming passive investing into a journey. With discipline, research, and flexibility, reaching $12,000 a month becomes an achievable goal. The best results come from thoughtful allocation. For those in their 20s, time is a huge ally. Funneling 50% into growth ETFs like QQQ, 40% into foundation ETFs, VTI, and 10% into income ETFs like SCHD maximizes upside over decades. In the 40s, shifting to 40% S&P 500, 30% SCHD, and 30% QQQ balances growth with stable earnings, helping raise teenagers and plan for retirement. As retirement nears in the 50s and beyond, safety and income take center stage with 50% income ETFs, 30% foundation, and 20% growth. No need to overhaul the portfolio every 5 years. Just adjust the sails as life changes, keeping the same strong ETF anchors in place. Simplicity leads to powerful flexibility. Consistency matters more than perfect timing. Regular monthly investments take advantage of market dips and keep risk low through dollar-cost averaging. Everything about this updated 3 ETF portfolio speaks to today's world: adaptability, global reach, and resilience. Old strategies aren't keeping up, but these ETFs are engineered for today's fast-paced financial landscape. The barriers to monthly income are lower than ever for those willing to modernize. The 3 ETF strategy delivers compound results without complex hassle. That $12,000 a month could be just the first step to a wealthier, more empowered life. Ready to upgrade that portfolio and start living on your own terms?
You're not supposed to turn $500 into freedom money. That's what people say, right? $500 barely fills your gas tank, let alone builds a life you don't have to escape from. But what if that same $500 could one day pay you $4,000 a month? Forever, without you having to work for it again? That's not fantasy, it's math. And it's the quiet power of dividend growth investing. The strategy nobody brags about on social media because it's slow, patient, and boring. Until it isn't. Until one day your portfolio starts sending you paychecks while you're asleep. Wealth doesn't come from winning trades or chasing crypto pumps. It comes from assets that pay you back over and over for decades. That's what dividend ETFs do. They take your tiny seed of money and build you a tree that keeps dropping fruit every single quarter. So, let's talk about how a small start, $500, can snowball into a machine that spits out $4,000 in passive income every month. Not maybe, not if you get lucky. Predictably, mathematically, step by step. It begins with mindset. Most people think investing means buying a stock and hoping it goes up. But dividend growth investors think differently. We buy businesses that share their profits with us, companies that have done it for decades, through recessions, pandemics, wars, still paying, still growing. Now here's what makes dividend ETFs so genius for beginners. They package dozens of those companies into one basket. So instead of guessing which stock is the next winner, you own all the proven ones, the legends, the cash printing machines. That's what funds like SCHD and VYM are built for. Imagine it this way. You put $500 into SCHD. That's the Schwab US Dividend Equity ETF. Inside it, you instantly own slices of Coca-Cola, Pepsi, Home Depot, Pfizer, Texas Instruments, real profitable businesses that pay shareholders cash every 3 months. And they don't just pay, they raise those payments every year. It doesn't feel exciting in the beginning. You might get your first dividend check for $5. You'll laugh. It's a coffee, right? But then you reinvest it, and the next time, that check is $6, then 8, then 12. Slowly and visibly, the snowball starts rolling. Here's where things get fun. Let's say you add $400 every month. That's not a fantasy number. That's Netflix, Starbucks, and Uber Eats combined. You redirect your spending, and suddenly your money starts working harder than you do. By the end of year 1, your total contributions, about $5,000, have already grown to roughly $5,400, assuming average market returns. Nothing wild yet. But that small foundation, it's a time bomb of compounding. Fast forward 5 years, still just $400 a month. You've put in $25,000. With reinvested dividends and growth, you're sitting around $33,000. And those dividends now pay you about $1,200 a year. $100 a month. That's your phone bill covered. From investments. No selling, no trading, just cash flowing in because you own real businesses that keep making money. Now here's the twist most people miss. The longer you do this, the less you contribute to the growth, because your portfolio starts compounding on its own. At 10 years with the same habit, $400 monthly, you're looking at roughly $70,000 to $75,000. And now your dividends? Around $2,800 a year, about $230 per month. So that's groceries. That's small freedom. But the moment you cross the 10-year mark, compounding begins to sprint, because dividends aren't static and they grow. SCHD, for example, has increased its dividend payouts roughly 10 to 12% annually. That means your income is climbing, even if you never add another dollar. By year 15, your portfolio hovers around $150,000. Dividends? Close to $6,000 per year. That's $500 every month, just for owning shares. And by 20 years, assuming an 8% annualized return and steady reinvestment, that same plan builds a portfolio north of $300,000. Your dividends now? Around $12,000 a year, $1,000 a month. Now imagine at that point, you start increasing your monthly investment from $400 to $800. The numbers start bending in your favor. The curve steepens. At that pace, within a few more years, you hit the magic zone. $1 million portfolio paying roughly 4% in annual dividends. That's $40,000 a year, or $3,300 a month. Push it a bit further, and boom, you're staring at $4,000 a month in pure recurring income. The crazy part? You didn't have to beat the market. You didn't have to pick the next Tesla. You just stayed consistent, bought broad market dividend ETFs, reinvested, and let time handle the heavy lifting. See, that's what the rich quietly understand. They don't chase money. They position it. They build systems where money reproduces itself. And the most beginner-friendly version of that system is dividend growth investing. It's not sexy in the beginning. It's like watching paint dry while your friends brag about day trading wins. But 10 years later, when their hot stocks crash and burn, your portfolio is still sending you checks like clockwork. Because this isn't a sprint, it's an ownership plan. You're buying small slices of cash-flowing empires, and those empires reward patience. The average dividend ETF pays 3 to 4% right now. But that's just the starting yield. The growth rate of those dividends is where the real compounding happens. For instance, if you earn $1,000 in dividends this year, and the payout grows by 10% annually, in 10 years, That $1,000 becomes $2,600 a year without adding new money. That's 160% more income from the same shares. Combine that with reinvested compounding, and suddenly your income graph starts bending upward like a hockey stick. Now let's talk about where those numbers come from. Because it's not magic, it's cash flow. Companies inside SCHD and VYM have real profits. When they pay dividends, they're distributing part of those profits to shareholders. You, as a holder of these ETFs, own small pieces of hundreds of companies doing exactly that. VYM, for example, leans towards stable, higher-yield names. Think big banks, telecoms, oil companies, while SCHD focuses on consistency and growth. Pepsi, Texas Instruments, Broadcom, Home Depot one gives you steady payouts. The other gives you rising ones. Together, they form a perfect balance for long-term compounding. Here's a visualization. Picture two plants growing in your garden. VYM is the strong, thick one that grows slowly but produces fruit early. SCHD is a smaller one that takes a bit longer but ends up towering, with branches full of fruit that multiply each season. Plant both, water them consistently, and in 20 years, you've got a forest. People overcomplicate investing. They think you need genius timing or secret information. You don't. You just need time, patience, and discipline. $500. That's it. You can start with that. It's not about how much you invest. It's about how long you let your investments breathe. That's the trap everyone falls into. They want quick money, but the quick money is fragile. The kind that disappears the moment you blink. Slow money, that's the kind that sticks around forever. If you look at the math, investing $500 up front and $400 a month for 20 years at 8% average returns turns into roughly $236,000. Keep reinvesting, keep compounding, and your dividends will start generating thousands per year, growing faster each time at an extra 5 years, and that $236,000 becomes $375,000. Add 10 years and it's $647,000. Time is the cheat code nobody uses. And the best part? The system doesn't care where you start. Whether you've got $50 or $500, the math works the same, just on different timelines. That's the first shift. Seeing your money not as something to spend, but something to multiply. Because the real goal isn't saving. It's ownership. You don't want to store money. You want to own the things that make it. And when you understand that, that's when $500 stops being small. It becomes your first employee, your first worker in a business you don't have to manage. And if you stay consistent, that worker hires more workers. Your money starts recruiting money. And that's when compounding stops feeling like theory and starts feeling like freedom. It sounds almost too good to be true at first, that a handful of dollars dropped into an ETF each month could turn into something that replaces a full-time income. But the math never lies and compounding never sleeps. Let's play the long game together for a second. Imagine you start the same way we talked about. $500 up front, $400 each month after that. You're not chasing the market. You're just letting the automatic purchase run every month like clockwork. That single habit is where everything changes because time is the multiplier most people underestimate. In the first few years, progress feels painfully slow. You check your account and see a few extra dollars, maybe a $20 quarterly dividend. But underneath that boredom, the real work is happening. The quiet cycle of reinvestment. Every dividend buys more shares, and those shares start paying their own dividends. The loop tightens. The machine starts to hum. Now let's stretch it out. 10 years in, you're seeing something that finally feels tangible. Your portfolio hovers around the mid-5 figures. The dividends that used to buy you a sandwich now cover a car payment. You start to understand what financial gravity feels like. Your portfolio is pulling in money without you doing a thing. By year 15, that number doubles. The cash flow doubles too. And here's where most people realize the game has flipped. The money you make from the market is larger than what you're putting into it. Every month, your investments are working overtime, and you're just supervising. This is when you can start adjusting the dials. Maybe you bump your monthly contribution a little. Maybe you let the snowball roll on its own. With funds like SCHD and VYM, those payouts keep climbing. 10% annual growth in dividends doesn't sound like much, but over a decade it means your income more than doubles. It's a quiet revolution happening inside your account. Picture this, a chart on the screen showing your dividends over time. The early years are a flat crawl, then somewhere around year 10, the line bends upward. The compounding curve finally wakes up. By year 20, it's a steep climb. That's when your portfolio hits 7 figures. At a 4% yield, that's $40,000 a year, $3,300 a month. Push it a few more years, and the number touches $4,000 monthly. The beautiful part? You didn't have to gamble to get there. You didn't even have to be perfect. The only skill required was consistency. And consistency is underrated. Because while everyone's out there looking for the next shortcut, the crypto that 10 times or the meme stock that can't lose, you're over here quietly buying assets that pay you cash just for holding them. It's not flashy, but it's real. Let's break down what those monthly payouts actually mean in life terms. $4,000 a month isn't just numbers on a screen. That's your rent or mortgage, that's groceries, utilities, and a few luxuries. That's the difference between working because you want to and working because you have to. And the craziest thing is, the strategy is so simple that most people overlook it. You pick quality dividend ETFs, you reinvest everything, and you let time do what time does best. Multiply SCHD gives you exposure to strong, cash-rich American companies that keep growing their dividends. VYM gives you a stable base of higher yielders that keep your income flowing mix in a small slice of JEPI if you like extra monthly cash flow, and suddenly your portfolio feels like a balanced living organism. Part growth, part stability, part income. Now here's where things get philosophical. Most people spend decades trading hours for dollars. Dividend growth investing flips that equation. You start trading dollars for hours, buying back your own time, one ETF share at a time. It doesn't happen overnight, but the day that your investments pay your rent, the game's over, you've won. And the truth is, you don't need to be rich to get started. You just need to start early, because compounding rewards time more than it rewards size. $500 at 20 years old grows into more than $5,000 at 40. But 500 at 40 barely scratches 1,000 by 60. The earlier you plant, the crazier the harvest gets. Now let's talk about the psychology of this. The hardest part of this journey isn't market crashes, it's boredom. Watching a dividend portfolio grow is like watching a tree. Nothing seems to change until one day it's towering over your house. The secret is to stay the course when it feels slow, because the boring years are when the roots are forming. When the market drops, everyone panics. Dividend investors smile because those same ETFs now pay higher yields and let you buy more shares for the same money. Every downturn is a sale on future income. That's why some of the wealthiest investors secretly hope for bear markets. They know they're just accumulating more cash flow for cheaper. So you hold, you buy through the dips, you reinvest those dividends automatically. And one morning you wake up, log in, and realize your portfolio made more money in dividends that month than you used to make at your first job. That's when it clicks. You didn't just invest money, you built an engine. One that never sleeps, never complains, and never asks for a raise. And the best part? You can design this engine however you want. Want more growth? Tilt toward S, CHD, and VIG. Want more yield now? Add a dose of JEPI or VYM. Want to balance the two? Go half and half. There's no perfect mix, just the one you can stick with. By the time you're 15 or 20 years in, the math starts doing backflips. Even if you stopped contributing altogether, your dividends would keep compounding. At that point, your portfolio is generating its own fuel, reinvested cash that keeps buying more income. That's the moment compounding goes from theory to autopilot. If you've ever wondered what financial freedom feels like, it's that. It's the calm of knowing your bills are paid before you even get out of bed. And all of it, every dollar of it, started with $500, a small seed. The kind of number most people dismiss as too small to matter, but the difference between $500 that's spent and $500 that's invested isn't $500. It's a lifetime. Because the truth is, you don't need a massive salary or insider access to the market. You just need patience and a plan. That's the dividend blueprint. Start small, add consistently, reinvest relentlessly, and let time do what time always does. Reward the ones who don't quit. At first, the money trickles in so slowly that it almost feels like a joke. A few dollars here, a small deposit there. Nothing that makes your heart race. But one day, something shifts. The numbers stop looking small. The dividends you used to ignore are now buying full shares every quarter. The curve you once thought was flat suddenly starts bending upward, and you realize compounding doesn't whisper. It roars, just very quietly at first. This is the moment most people never reach because they stop too early. They get bored or distracted or panic when the market dips. But if you hang on, the exponential part of the curve starts to reveal itself. The snowball doesn't just roll now, it accelerates. Picture it. You're 20 years into your journey, and your portfolio is sitting comfortably north of $1 million. You've built this machine slowly, piece by piece, one ETF purchase at a time. SCHD has done its job, delivering steady growth and raising its dividends almost every year. VYM's steady yield has kept your income solid even through rocky markets. The mix of the two means you've captured both rising payouts and stable cash flow, and now that balance is paying off. At a 4% yield, you're earning about $40,000 a year in dividends. That's $3,300 every month, deposited like clockwork. It's no longer a theory, it's rent, groceries, travel, and peace of mind, all covered by the same system you built with a single $500 deposit years ago. Add just a few more years of patience, and that number crosses $48,000. $4,000 every month. The number that once felt laughably out of reach now lands in your account automatically. Quarter after quarter, it's not luck. It's not genius. It's just time and discipline playing out exactly as the math said it would. Now imagine what that freedom actually feels like. You wake up on a Monday morning and realize your portfolio earned more in dividends over the weekend than you used to earn working an entire week. The pressure that used to sit on your shoulders, gone. The bills, the deadlines, the "I can't take a day off" mindset, gone. Because money is no longer something you chase, it's something that quietly arrives. That's what makes dividend investing so powerful. It doesn't change your life in a flash. It rewrites it line by line until one day you look back and realize you're living in a completely different story. You went from consumer to owner, from paycheck to cash flow, from stress to stability. And the path was never complicated. It was just about showing up month after month, no matter what the headline said. Because the truth is, the market rewards those who stay. Every crash, every correction, every worst year ever is just another sale on your future income. Those reinvested dividends you pick up during the hard times become your biggest paychecks later. The hardest part is trusting the process when it's quiet. But if you stay the course, you realize something else. Your portfolio becomes your business partner. You've built an invisible company that runs 24 hours a day, paying you a steady salary for the rest of your life. And all you had to do was let it grow. Here's the secret most investors never talk about. The goal isn't to get rich, it's to get free. When your dividends cover your living costs, your time becomes your own. You can choose to keep working, travel, build something new, or do absolutely nothing. You've decoupled your income from your labor, and that's the moment you cross the invisible line between surviving and living. This is what the $500 to $4,000 journey really represents. Not just numbers, but transformation. A shift from instant gratification to delayed exponential reward. A shift from fear of losing money to confidence in building wealth. Because once you've seen compounding work in real life, you stop looking for shortcuts. You realize time was the shortcut all along. So if you're just starting, don't worry about the small numbers. Don't worry about whether you can contribute $100 or $400 each month. Worry about consistency. The first habit you build is worth more than any stock pick. Set up that automatic investment. Pick your ETFs, SCHD, VYM, maybe a small slice of JEPI for monthly income, and let them do their job. Reinvest everything. Watch it grow slowly, then suddenly. And 20 years from now, when that $500 seed has turned into a money tree, feeding you $4,000 a month, you'll realize something profound. Wealth isn't created in moments. It's built in the spaces between them, quietly, patiently, compound by compound. So take the first step today. Don't overthink it. Open the account, buy your first share, and start the clock. Because every month you wait is one less dividend payment your future self could have earned. Your freedom is hiding inside the math. You just have to give it enough time to reveal itself. And when that day comes, when your money finally makes more money than you do, you'll understand what all of this was about. It was never just about the $4,000 a month. It was about the feeling of never needing to ask. If that's the kind of freedom you want, start today. Take that first $500, put it to work, and never stop feeding the snowball. And hey, if this opened your eyes to what's really possible, hit that subscribe button, drop a like to help the algorithm push this to more future investors, and leave a comment below telling me how much you're starting with. Let's grow your income and your freedom together.